Welcome to The Explainer. Today we're talking corporate debt. We're going to pull back the curtain and see exactly how the pros figure out if a company is a solid bet or, a total train wreck just waiting to happen.
All right, so here's how we're going to break it down. First, we'll get into the basics of credit risk. Then we'll check out the super important rating scale analysts use. After that, we'll see how debt tells a story, look at some huge companies as examples, and wrap it all up with the one thing that really, truly matters at the end of the day.
So let's say a massive company wants to borrow billions of dollars. How in the world do lenders decide if that's a smart move? Well, it all kicks off with a really deep dive, kind of like looking into the company's financial DNA.
And that right there, that is the multi-billion-dollar question, isn't it? Because here's the thing, debt can be both. It can be the fuel for amazing growth, or it can be the anchor that sinks the whole ship. And that's exactly why analysts do what they do. They perform credit analysis to figure out which one it is.
Really? When you strip it all away, this is what it's about. Analysts are just trying to figure out the odds. What are the chances that a company, for whatever reason, just can't pay its bills? It's all about putting a number on that risk of default. So to do that, they basically become financial detectives. They're asking all these questions, like profitability and cash flow. Is the company actually making money from its main gig? What about liquidity? Do they have enough cash just sitting there for the bills that are due right now? Then there's asset efficiency. Are they getting the most bang for their buck from their factories and equipment? And then, the big one, debt service capacity. After everything, can they really afford the debt they already have, let alone take on more? Okay, so after all that digging, all that detective work, an analyst has to make sense of it, right? They need a simple way to sum it all up. And they do. They boil it all down to one simple but honestly incredibly powerful tool, a risk rating scale. A lot of the time, they just use a simple one-to-one scale. And really, the two ends of that scale tell you the whole story. A 1, that's like a financial fortress, absolutely rock solid. A 10, that means the company is already toast. They're in default, bankrupt, it's game over. And here's what's super interesting. That internal score an analyst comes up with, it lines up almost perfectly with those famous credit ratings you hear about on the news, from places like S&P and Moody's. So for example, if a company gets an internal score of 3, that's pretty much the same as getting an A or AA rating. It's a direct translation. So let's be clear, the bottom line is this. The whole point of this entire exercise, all the spreadsheets, all the analysis, it's all about calculating one thing, the probability of default. The higher that score, the higher the chance the company won't be able to pay back its loans. Simple as that. But a single rating, that's just a snapshot in time. The real magic, the real insight, comes when you watch how that rating changes over the years. Because these numbers, when you track them, they start to tell a story. A really fascinating story about where a company is going, what it's struggling with, and what its biggest dreams are. Yeah, so when an analyst looks at that trend line of debt, they're not just seeing numbers on a page. They're asking these huge questions, like what's this debt for? Are they borrowing to build something new and exciting, or are they just borrowing to keep the lights on? Can they even afford this? It's almost like they're a financial storyteller, just trying to figure out the plot. All right, so theory is great and all, but let's make this real. Let's apply this way of thinking to 3 companies you've definitely heard of. We're going to see how these debt stories actually play out in the real world, with real companies and, billions of dollars at stake. First up, we've got Goodyear Tire and Rubber. And just look at this. Their debt story is a bit of a roller coaster, right? You can see they worked super hard to pay it down after 2013. They chopped it in half. But then it starts creeping back up, kind of settles around $5 billion. But the real head-scratcher for an analyst is what's going on in 2020. All of a sudden, bam, it jumps by over $1 billion. That jump is the first thing an analyst is going to zoom in on, and they're going to ask, is this a huge red flag, or is it a sign of ambition? If they're borrowing for a smart acquisition, investors might love it. But if they're just borrowing money to cover up problems, well, their credit rating could take a hit, and that makes all their future borrowing way more expensive. See, the story is always in the why. Okay, next up, the mining giant Freeport-McMoRan. And wow, this chart tells a seriously dramatic story. Look at this. Their debt just explodes to over $20 billion back in 2013, and it stays up in that danger zone for years. But then, right around 2016, they pull off this incredible turnaround, and they slash that debt in half. And again, the big question is, how? How did they do that?
If they paid it down using massive profits from their mining business, that is a huge sign of strength. That could send their stock through the roof. But what if they had to sell off important parts of their company just to get the debt under control? Well, that could mean the company is actually shrinking, and that signals weakness. Totally different stories, right?
And for our last one, a company you've maybe heard of, Tesla. And here, the story is just one of aggressive, nonstop growth. And a big part of that growth has been paid for by a steady and pretty significant increase in debt, year after year after year.
Now, for a company like Tesla that's growing so fast, debt isn't automatically a bad thing. The absolutely critical question is, can the company's actual performance keep up with this growing mountain of debt? If the business grows faster than the debt, they could literally dominate the whole industry. But if the business stumbles, they could face a massive cash crunch, and that puts the entire company at risk. It's a race, right? Can the business engine outrun the debt engine? So, we've looked at the rating scale, we've looked at the trends, we've seen some real-world examples, and it all boils down to one fundamental bottom-line principle. This is the thing that guides every single credit analysis. And here it is, the ultimate takeaway. A healthy company should be able to pay its debts with the money it makes from its main business, plain and simple. Not from selling off pieces of the company, not from some clever financial trick, but from its actual day-to-day operations. That, right there, is the #1 sign of a financially healthy company. So, from now on, when you see a headline about some company's debt, you'll know it's so much more than just a number. It's another chapter being written in that company's story. And now, you know exactly what questions to ask to figure out what kind of story you're reading. A comedy, a tragedy, or maybe an epic tale of success.